Hi everyone, nice to see a great crowd here. So I'm Cheryl from CityWire Asia. Join with me today. Maybe I should give my panelists 1 or 2 minutes just to introduce yourself.
Should I go first?
Yeah.
Hi everyone, my name is Eric Chng. I work for State Street and I am Senior Managing Director and I run the alternatives, which is more in focus today, and the insurance business segment.
Good afternoon, my name is Sean Darby. I'm the Global Equity Strategist for Jefferies, based in Hong Kong. I've been living and working in Asia for over 20 years, and I cover all the markets from the US through to the Philippines.
Good afternoon, my name is Joy. So I'm currently the Chief Asia Economist for Point72. I'm based in Singapore. So I basically cover the economic research in the region.
Thank you for sharing, everyone. So maybe just to start off, we want to know what is the current macro backdrop that we are seeing right now with the war, inflation, COVID. So what are the most resilient markets that we have also seen? Maybe start with you, Eric.
Sure. Thank you. It's a very wide topic, so I put together some talking points which hopefully helps you today. In terms of the macroeconomic environment, what we see is that the emerging market has reacted faster than most developed markets. And that's based on policy tightening and the inflation threat. Certain markets, most notably in the LATAM, we've seen have been rewarded for this. Now, the challenges for emerging market has been, with no surprises, the US dollar strength, right, that we're all seeing. Higher developed market yields, which then have reversed the extensive capital inflows that has propped up emerging markets, putting pressure on their currency. And then the story continues. The pressure on the currency led to FX depreciation, is exacerbated inflation fears, and then creates this vicious loop for the emerging market on capital outflow. Some have managed this better than others. Ostensibly in Asia, like FX reserve are being drawn down to defend certain currencies. Now, lower trade volumes is what we observe, obviously, as a result of all these macroeconomic headwinds. I think in Asia, China, it has been a challenge, and it's just purely simply is an export-led economy. Looking into the world of private markets, in between are the world of hedge funds. Now here we've seen hedge funds started to see opportunities with outperformance, notably within the world of CTA, macro, arbitrage, and quant strategy. So over the last 1 to 2 months, we've seen a lot of quant clients now starting to take on investors. And in return, investors, the LP on the other side, which have traditionally flowed a lot of money and allocation into private market, are now seeing an increased demand to allocate into hedge as a counterbalance strategy. And lastly, I would say in private markets, although the fundraising has slowed considerably over the last 12 months, I would say that there's a flight to quality. Some of the largest LP with track record, they will still continue to attract fundraisers. But more importantly, a new trend to end my overall distressed asset and credit funds. Now, these are also a means for LP to start looking at diversification into alternative strategies. So that's a brief overview. In terms of resilience, I think what we've generally seen is LATAM has held up very well, notably in Brazil and Mexico, and they were early to hike rates, and they have seen inflation trends kind of reverse, and real interest rates are both positive. And this then in turn supports fixed income. Over in EMEA, bad story, no surprises there of the ongoing war. Ukraine, Russia, Turkey, major economies being hit. Investor community generally punishing Europe across Central, all the way to developed Europe. And Asia, often a play on China, particularly very much impacted by the ongoing zero COVID and dynamic COVID kind of impact, and that's led to weaker aggregate demand. So lastly, Southeast Asia, very much better. It is a bastion of hope. Although allocation tend to be a lot smaller compared to traditional markets of North Asia, it is showing a little bit of resilience here. So hopefully that helps everyone.
Sean, maybe any interesting insights from your view?
So I think perhaps the thing about Asia and emerging markets is they're not homogeneous. They're an asset class, but the various economies and financial markets are very disparate. So you have an economy like Poland and Turkey with very high levels of inflation, and China, which is sort of going into deflation. You have Latin America, Brazil and Mexico, which have done the right thing and taken real interest rates very high. But you also have a couple of the economies where real interest rates are still very negative, and they're still having to move those up. Places, for example, like Korea. I think perhaps the good thing about the last sort of 24, 36 months is that by and largely the Asian emerging markets came into the pandemic with actually robust current account surpluses. And fortuitously, compared to 2018, 2019, we've had a commodity cycle in the background. So that countries that might have been prone to a scare like Indonesia or Malaysia have actually operated pretty well. So I think that's been a nice part of the cycle. I think the last thing to say is that there's been one or two economies that have actually done some reforms, which is very rare these days. I think Greece is in that camp. And that really means that for the fund managers and investment communities, there should be a great deal of alpha on the table going into 2023.
And Joy, maybe your perspectives, especially with China.
Yes, I think before I say something about China, I'd like to have a top-down view first. Basically, for the past almost 3 years, most of the markets are struggling with the COVID story. And currently, most of the country has reopened pretty much fully already. And China seems just to be making the first few steps about reopening. However, I think for the past 2 to 3 years, probably we and the market a little bit get distracted from this COVID story, although it lasted as long as 3 years. But still, in terms of the big history, the long history, 3 years is really not a lot. And also, the beginning of the year, we also get distracted a little bit by the Ukraine war. But I'd say that let's not forget, before the COVID hit in early 2020, actually China and the United States just signed the Phase 1 trade deal. And that story was kind of like paused, partly because of the COVID and also partly because US had a different president. So I would say that now COVID story is pretty much in the history, except for China and a very limited few countries. And maybe for the next 5 to 10 years, we will start to see a resumption of the intensified relationship between the United States and China, which we're seeing already in some of the areas. For example, a few months ago, Nancy Pelosi's visit to Taiwan really made everybody quite nervous and thought like we're just 1 inch away from a pretty ugly geopolitical conflict in Asia. So what I worry is that if we look at for the past 20 years, 20 to 30 years, that was after China joined the WTO. Actually, the emerging market has been benefiting from this big globalization for the past 20 years. And the advanced economy is giving a lot of its productions to the emerging market. Obviously, China is the biggest beneficiary, but also a lot more emerging market benefited from such process. And if there was no trade war and if there was no conflicts in some other areas between the biggest two nations in the world, some of the emerging market is supposed to take over part of the supply chain from China, because China is supposed to move up, and then Vietnam or Southeast Asia or Latin America, they will take over the lower end. But then this globalization will continue with a more comprehensive supply chain. However, because of the trade war and because of the increasingly disagreement shared by the two big nations on the ideology issues, so I'm afraid that the emerging market for the next 10, 20 years will not be in the sweet spot as they have been for the past 20 years before the COVID hit everybody. So this is the biggest challenge we're going to and actually, I really don't have an answer, because I think this is something that none of us has really experienced, because we just experienced the globalization, right? We never really experienced deglobalization and how it's going to play out for many of us. So I think there will be a lot of uncertainties. I will kind of inclined to pick some of the economies whose resilience is generated from its own domestic sector, because there will be a lot of unpredictable risks from the external side, both through the trade link and also through the geopolitics link. So if an emerging market is more reliant on its own domestic sector, in my view, probably these are the ones who can be a little bit more resilient.
Thank you for sharing, everyone. How would then we see emerging markets as an asset class having evolved over the years, and particularly highlighting what are the factors that investors would be taking note of with all this uncertainty factored in? Maybe you want to go?
Me?
Yeah?
Okay, 1, 2, 3.
I'll shake it up later.
Yeah. Well, emerging market generally, I would say, as an asset class, kind of a weird way to classify it, is liberalized in terms of the balance of payment, capital controls, and generally they've moved away from a fixed regime of currencies. So I think this has created a greater investment opportunity within this asset class itself. Investor interest has also risen, and we do note that the EM-only mandates or emerging markets-only mandate have increased over the years. EM remains a relatively low level of investor exposure. I think it's helped with indexes coming in, like the MSCIs of the world, tracking those baskets. But you know, the liquidity is just not there. And for that reason, the area where I come into play in the world of alternatives, we've seen private markets increasingly dominate in the world of, say, Southeast Asia that we just mentioned earlier on, because the ticket sizes that private equity can write is generally higher, and they crowd into the venture capital space. So I would say investors then have in turn focused their attention into allocation into private markets to gain proxy exposure in a more stable manner in an otherwise less liquid market, for want of a better word. And so since 2012, again, data that we collect suggests that private market has net been a positive cash flow distribution basis kind of market, with APAC being the youngest region. And we'll start to see harvest coming in the next 5 to 10 years.
Sean?
Well, I'm going to disagree with my two panelists to sort of throw a spanner in the works, because the first thing I would say is that if you look at trade between the emerging markets, that has actually been picking up pretty rapidly. And we wrote about a group of countries which we called West Asia, and that was the Middle East, India, Israel, Turkey. And the fact that all these countries now have signed trade agreements and peace agreements was bringing a group of emerging markets that had little to do with China, and which had essentially geopolitically very different aspirations, and creating a different time zone and regime of countries which would not normally be related at all. And I think at the moment that hasn't really got into the mainstream. It has some of the youngest population in the world, some of the largest FX reserves. And I think in a way that's going to be maybe a stereotype for how emerging markets grow in the future without really any US involvement. I think the other thing I've found is that we have to look at, whilst the asset class isn't homogeneous, in the last 5 years, the weighting of Middle East in the index, UAE, Qatar, Saudi Arabia, all have mushroomed. And I know that it's on the top of a lot of people's minds about indices that are ex-China now. But if you do strip out China from the EM universe, you're actually left with mostly large cap Middle East companies. So I think, as I say, I was going to throw a spanner in the works, but I'm more optimistic, because I think we've got to not look at things in a static fashion. I think there's the evolution of emerging markets means there's much more countries to invest in, and paradoxically, they're embracing financial liberalization very rapidly. So you can invest in the equity markets and the capital markets. And I certainly wouldn't have been writing about the Middle East 3 or 4 years ago, but really now it's a really big part of the GEM portfolio. But I was being provocative, so I just wanted to make things interesting for everybody.
Joy?
Yeah, well, actually, the emerging markets are very different. even just within Asia, we have commodity exporters. We have some emerging market who's focusing on the manufacturing sector. We have some ones who has younger populations than others. So it's really hard to generalize for just one group of emerging markets. But just to continue what I said from the previous question is that I do see this deglobalization trend is going to continue, and that is the theme for the next few decades. And that actually reminded me that the economics I learned back in my college time, the Econ 101 macro, the first lesson is always like trade is the best way to improve your efficiency. And when I was teaching economics at UCLA, there's always one question asking my students to prove how country A and country B trade so that both of them can improve the efficiency and both of them gets more, right? But not until recently, I realized that we took it so much for granted, and it's actually not the real world. Because the textbook only focused on the efficiency, but the real world, you have to hedge certain kind of risk. The textbook will never tell you that what if country A and country is no longer friends? And what if country A is having a COVID and all the production is being shut? Okay, so if you're trading like cotton for staying warm versus wheat for staying hungry, for like not being hungry, then at some point, you just have to choose between one of them if you don't do diversification. So I think the emerging market for the next few decades, I would argue that there will be an increasing trend that some of the supply chain will be shifted out of China, but towards some other emerging markets. And that is simply for the diversification purpose rather than for the efficiency purpose. And whoever economy who can benefit from that, probably number one, with better infrastructure, number two, with a younger population. Actually, in short, just like the China 20 years ago. And then on top of that, those ones who are a little bit immune from the geopolitics risk in the region, especially the conflict between the United States and China, I think those ones are likely to benefit, and I would be more confident in them.
Mm-hmm. Thank you. And one of the major developments that have happened in the past week, actually, it's maybe in a question on the minds of us is: are we seeing that China pivot, the shift in terms of property, COVID, and also geopolitics, improving of relationships? Maybe I'll start with Sean this time. How do we see that China pivot coming?
Well, okay. Yes, I have to admit that especially with the market sell-off for the year to date, the valuation in China is getting more attractive. It really depends on how long is your investment horizon is. If it's just for the next couple of months, I would also say that I tend to be more optimistic because all the negative news seems to have been largely priced in by the market already at this point. And also sentiment has dropped to a really low level. So a little bit rebound from this point, especially given some of the encouraging news these days, like China's reopening, China's trying to ease a little bit on the property sector. President Xi just met with President Biden yesterday, will be the hope for the market that let's take some rally from this point. But how sustainable it will last, really, I don't have a good answer. And I think we'll just have to watch the data and development. But again, if we're talking about 5 years or 10 years or even longer horizon, I think I think President Xi, compared with his predecessors, his focus on the domestic affairs is very different. His common prosperity and all these things seems to emphasize that the people's benefit, people's social welfare is not just being defined by economic growth. So it seems that he's willing to let go some of the rapid growth in the past, but in exchange for a more ideal life for the Chinese people in his definition. And this will be a pretty dramatic shift because in the past 20 years, all China is pursuing is about growth. And because of this is the top priority, so they can let go some of the financial stability because they have the room to accumulate some of the leverage. They were also a little bit tolerant on the pollution, which is normal in the early development stage for any of the emerging market. And but now we have reached the point that China's structural focus has shifted. So I guess this is the thing that we have to bear in mind if you're investing in China for the next 10 or 20 years. Yeah.
if somebody said to me last week on Monday that China would begin to relax its COVID restrictions as the number of cases went up and as we went into the winter season, I would have given a low probability. And I mentioned that last Monday. So if you read the report, I have to say on Friday I changed my mind. And I changed my mind because the authorities are looking down a deflation abyss. And the earlier that you tackle that, the better and much more quicker the response will be. So since the beginning of COVID, the household and corporate sector in China has saved in excess of the German economy. That's a huge deadweight for the economy at a time when the unemployment rate amongst the youth is about 20%. I think the second thing I would want to highlight is that there's a lot of wherewithal in China to fix problems. And essentially, they've got boxed in by the COVID issue. Maybe the way to frame things is that the preliminary estimates for the birth rate for China in 2022 is just 10 million babies, whereas pre-COVID it was 15. So the juxtaposition of seeing a drop in the birth rate and perhaps the more difficult circumstances amongst the elderly in China has actually started to play a part in all of this. The one last thing I would say that gives me more comfort that the authorities probably are going to succeed is that the people in the bond market in China have lost a lot of money in the last 48 hours. Mm-hmm. And owning bonds in the last 3 years was a great trade in China. So the more, I have to say, people lose money in bonds in China is probably telling you the deflation story is starting to end and the reflation story is starting to begin. I hope nobody is investing in government bonds. I'm an equity strategist, so that's my that's my insurance policy for my job. But over to you, Eric.
Now, look, I think both my esteemed panelists are the resident Chinese experts. I'll attempt to talk a little bit on the momentum side of the observations that I make. You've seen the Chinese equity market react to the slightest form of good news. And it tells you one thing, right, from an investor sentiment, that generally most of the investors are underweight China, either by force or just sheer uncertainty. There is the continued talk about policy being freed up pretty soon by the government now that everything is back. The dynamic COVID zero policy, I'm not going to attempt to predict when this will come into fruition, but generally I think between now and March next year, the House view is that the Chinese government will take very little baby steps to kind of reignite or reopen. But down in the world of private market where we see a very different kind of investor profile, people are getting ready to deploy capital, not just in the public market, but the private market side as well. Non-performing loans becoming very important and a lot of focus. It tells you that it just takes a certain trigger, right, for China to signal a reopening, and we expect that there could be a meaningful recovery, shorter rather than a longer duration.
Eric, since you're on private markets, maybe I should just ask, what is your take on how investors are also feeling about the opportunities in emerging markets and frontier markets, which we didn't get much time to talk about? Yeah. Which markets are you seeing like the most growth or interest? So zooming out on not just China.
Yeah, let me just talk in general. I think one of the key questions you asked, like what are the tailwind, how do we accelerate growth when you look across all these markets or asset classes? I think generally across emerging markets and even that of frontier market that I think you alluded to, valuations are cheap in equities and many FX pairs. Relative yield right now, generally more attractive in emerging markets although there's less of a tailwind in the current cycle versus the developed markets. I think there's a stronger fundamental around the reserve accumulation in the world of emerging markets. Balance of payments are a bit stronger. I stated earlier on my observation that private markets are starting to play a meaningful role in some of these emerging and you can argue frontier markets. And I think frontier market is a different story. It has got a very difficult time this year. Fundamentally, it's a lot less sound and their CPI basket is made up mostly of basic food items and energy. And a spike in all these prices have caused a lot of crisis for governments, right? Bangladesh being an example, and even Sri Lanka. So a lot of pressures on public finances. Quantitative tightening, I think it's going to be another foot down, of many economies. And frontier market, not in favor, at least from what we can see. Private markets, it's seen exponential growth in the last 10 years. So I'll talk a little bit about private markets. And I keep coming back to private markets because I kind of see the world between public and private as one and the same, just a different duration and the illiquidity premium being a bit different. I think just interesting stats. 20 cents to the dollar raised today is coming from an Asian-based investor as compared to 10 years ago, where that number is closer to 2% of every dollar. And I think more importantly, the investments in the private market dominated by China, India, but increasingly Southeast Asia, the tech play, the unicorn that you read about. Given the macroeconomic headwinds that we just spent the last 10, 15 minutes discussing, private asset classes, due to the very nature of it being more illiquid, is more patient in terms of the capital. And we're seeing an over-allocation by some of the LP on the other side, and it's leading to with valuation now starting to come under stress, like the public market, leading to a search for an answer on how best to diversify. A couple of key highlights. Venture capital valuations over the last quarter, down sharply quarter on quarter. And we're seeing early stage funds taking the worst hit, and there's no surprises there. And I think that number, when I last checked, was close to about 13% under. Private equity has not been spared. It is the largest sub-segment asset class within the world of private market. The mid to large cap buyouts are suffering drops in valuation as investors wane on the lack of payouts, a lack of investment opportunity, a rising interest rate environment. Dry powder falling down by 10% from a peak of 1.7 trillion globally. Just first half of 2022, it's down 10%, as I just said. And you correspond that with unfunded commitments that we see across the board globally. There's just been an increase of unfunded commitments. And it's telling you that LPs are struggling, with limited distribution, over allocation of private market, public markets reacting very wildly. Where do you draw the line? How do you create a new efficient investment frontier, right? So I think those are some of the kind of points that I jotted down to answer that question. I'll give my time to the rest of the panelists.
Maybe in interest of time, I will just shoot over my two panelists the last question. What are your favorite frontier markets, or you think something that we should take note of? And very quickly, some reasons for that because of the time.
Well, I'll just say the only frontier market I cover is Vietnam, and it's been able to manage the cycle very well. It's taken a very proactive stance about devaluing its currency quite early on. It's got a very low inflation rate, so the central bank has been able to, again, not necessarily worry too much about the move in US rates. The only thing that irks me a little bit about Vietnam is that it has itself absorbed a real estate bubble. And I think the authorities are in the throes of pricking that, a bit like China did maybe 3 or 4 years ago. I don't think it's fatal, but I think it's exposed what always happens in emerging markets, that you get hot money inflows and it goes into very unproductive areas. But I would still vote yes for Vietnam. And I think, again, its story is one which Joy mentioned. Really, it fits the whole theme of outsourcing and a neutral country. So Vietnam would still get my vote.
Thank you.
Yeah, I would tend to agree with Chng on that, especially like Vietnam, in many people's views, is regarded as the new China, that they share a lot of similarities with China 20 years ago. But I think it's unfair just to name one or two emerging markets. Again, I think it really depends on if that emerging market has some buffer to go with a more chaos in the international political system and risk, and handle that and develop its own pretty strong domestic sector, because for the next few years, probably the export-led growth, which has been playing out well for many of the emerging markets, may not be the case for the next few decades. But in any case, I believe there will be a few more good emerging markets which shares some of the good features, just like Vietnam has globally. Yeah.
Okay, thank you so much for my panelists for sharing.